Most people think they know what caused the financial crisis of 2008. Greedy banks handed out mortgages to people who could never afford them. Wall Street packaged those bad loans into securities. The housing bubble burst. Lehman Brothers collapsed. And suddenly the global economy was falling apart. That story is simple, memorable, and partly true. But here is the problem. By the time Lehman filed for bankruptcy on the 15th of September 2008, the financial system had already been cracking for more than a year. Lehman did not create the crisis. It exposed how fragile the entire machine had become. Bear Stearns had nearly collapsed 6 months earlier. Mortgage lenders were already failing. Housing prices were falling. Securities linked to home loans were becoming nearly impossible to value. Banks were growing suspicious of one another because nobody knew who was holding the losses, how large those losses were, or who might fail next. So, how could mortgages written to ordinary families in Florida, Nevada, Arizona, and California threaten investment banks in New York, pension funds across America, and financial institutions thousands of miles away? The answer was not simply bad borrowers. The mortgages had been connected to a much larger financial machine. Cheap credit fed the housing boom. Mortgages were turned into securities. Credit ratings made risky assets appear safer. Banks borrowed heavily to increase returns. Short-term funding kept the machine running. And when housing prices began falling, weaknesses that had seemed separate suddenly started feeding on one another. Lehman was the match. Wall Street had spent years filling the room with gasoline. Comment 1. If you think Wall Street greed and bad mortgages were the real cause of 2008, comment 2. If you think Lehman was only where a broken financial system finally exploded. By the end, we will come back to those two choices. Because to understand what really caused 2008, we have to go back before Lehman, before the panic, and even before the subprime mortgage boom. We have to begin when the most dangerous thing in the system still looked completely harmless: cheap money. The story most people remember goes something like this. Banks made reckless loans to people with weak credit. Mortgage brokers pushed products borrowers barely understood. Wall Street bought those loans, packaged them into securities, collected fees, and passed the risk on to investors around the world. Then housing prices stopped rising. Borrowers began missing payments. Mortgage securities started losing value. Financial institutions that had loaded their balance sheets with housing-related assets suddenly faced enormous losses. Lehman Brothers failed. Panic spread through Wall Street, and the United States entered the worst recession since the Great Depression. None of that is imaginary. Subprime lending mattered, weak underwriting mattered, securitization mattered, excessive leverage mattered, Lehman's bankruptcy mattered. The mistake comes when all of those things are compressed into one clean story and treated as though they played exactly the same role in causing the disaster. Some were structural weaknesses that had accumulated for years. Some amplified losses once housing turned downward. Some transmitted those losses from homeowners to global financial markets. Others were triggers that transformed a slow deterioration into a full-scale panic. Cause, amplifier, trigger, and consequence were not the same thing. That distinction matters because the financial crisis did not begin on the morning Lehman filed for bankruptcy. By then, mortgage lenders had already failed, credit markets had already shown signs of stress, and investors had already started questioning assets that only a few years earlier had been treated as exceptionally safe. So if we really want to understand the origin of 2008, we have to move backward through the machine. Before the toxic securities, before the weakest mortgages, and before Wall Street's leverage, there was a more basic condition making almost everything else possible. There was an extraordinary abundance of credit. To understand why so much money rushed into American housing, we have to go back to the years before the crash. After the dot-com bust and the 2001 recession, borrowing costs fell sharply, while enormous pools of global capital were searching for investments that offered better returns. The Federal Reserve kept short-term interest rates unusually low for several years. At the same time, savings from countries such as China, Japan, Germany, and major oil exporters flowed into American financial markets. Money was abundant, funding was cheap, and investors were increasingly willing to reach for higher yields. This does not mean low interest rates alone caused the crisis. Economists still debate how much responsibility monetary policy deserves. Some argue the Federal Reserve kept rates too low for too long. Others emphasize global capital flows, financial innovation, weak regulation, and the declining price investors demanded for taking risk. But cheap and abundant credit changed the environment. Mortgage rates became attractive. Banks could borrow more easily. Investors wanted assets that paid slightly more than government bonds. Housing offered something especially appealing because American home prices had been rising for years and appeared remarkably stable on a national scale. That created a powerful feedback loop. Easier credit brought more buyers into the housing market. More buyers pushed home prices higher. Rising prices made mortgages appear safer because borrowers could refinance or sell. That apparent safety encouraged lenders to extend even more credit, which brought still more buyers into the market. Nothing about cheap money guaranteed disaster. Credit can finance businesses, homes, investment, and economic growth. The danger came from what the financial system began doing with that credit, and from the assumption that rising home values would continue protecting lenders from the consequences of increasingly risky loans. Because once investors developed an enormous appetite for mortgage-related assets, Wall Street needed one thing above everything else: more mortgages. And that changed the incentives of the people making the loans. The next stage of the crisis did not begin inside a trading room. It began at the mortgage desk. By the early 2000s, American housing had developed an almost dangerous reputation for safety. Home prices had been rising for years, and many borrowers, lenders, investors, and policymakers came to believe that even if local markets weakened, a nationwide collapse in housing prices was extremely unlikely. That belief changed behavior. If a homeowner struggled with payments, rising property values offered an escape. They could refinance, borrow against accumulated equity, or sell the house before default became permanent. As long as prices kept climbing, even questionable mortgages could appear far less dangerous than they really were. The logic became self-reinforcing. Easier credit brought more buyers into the market. More buyers pushed prices higher. Higher prices made lenders feel safer. That apparent safety encouraged even looser lending, which created still more demand. Each turn of the cycle seemed to confirm the assumption that housing could only keep rising. This did not mean every homeowner was reckless or every lender was corrupt. The deeper problem was systemic. Mortgage brokers earned fees for producing loans. Lenders could often sell those loans instead of holding them for decades. Investors wanted more mortgage securities. Everyone had a reason to keep the machine moving. As the boom continued, lending standards weakened in important parts of the market. Borrowers with lower credit scores gained access to mortgages. Adjustable rates, low initial payments, limited documentation, and other non-traditional loan structures became more common. Rising home prices made those risks look manageable because the collateral itself appeared to be becoming more valuable. But that entire structure depended on one assumption: surviving. Home prices did not need to rise forever, but they could not fall sharply across the country at the same time. Once that assumption failed, the protection vanished. And by then, Wall Street had already found a way to spread those mortgages far beyond the neighborhoods where they originated. For decades, traditional mortgage lending followed a simple logic. A bank evaluated a borrower, made the loan, collected the payments, and lived with the consequences if that borrower defaulted. Because the bank expected to hold the mortgage, it had a strong reason to care about whether the loan was actually sound. But by the housing boom, that relationship had changed. Many mortgages were no longer staying with the institution that created them. Brokers originated loans, lenders funded them, larger financial firms purchased them, and Wall Street bundled them into securities that could be sold to investors across the United States and around the world. This became known as the originate-to-distribute model. In theory, it made the financial system more efficient. Banks could free up capital, investors gained access to mortgage income, and risk could be spread across a larger market instead of remaining concentrated inside a single local bank. But the model also created a dangerous incentive problem. If a mortgage broker earned a fee when the loan was completed, and the lender expected to sell that loan soon afterward, neither necessarily carried the full long-term cost if the borrower later failed to repay. As investor demand for mortgage securities increased, Wall Street needed a constant supply of new loans. Mortgage originators had every reason to produce them. Lending expanded deeper into the subprime market. Documentation weakened in parts of the industry, and increasingly complicated loan structures allowed more borrowers to qualify. That does not mean every subprime borrower was irresponsible, or every subprime mortgage was fraudulent. Subprime simply referred to borrowers considered higher credit risks. The real danger came when weaker underwriting, risky loan structures, rising leverage, and relentless investor demand began reinforcing one another across the entire mortgage supply chain. The machine had discovered how to produce mortgages at enormous scale. But producing loans was only the beginning. Wall Street still faced a much harder problem. How could thousands of mortgages, including risky ones, be transformed into securities that major institutions could treat as safe investments? That transformation would become one of the most important mechanisms of the entire crisis. Risk was about to be sliced, packaged, rated, sold, and distributed across the financial system. And, somewhere along the way, many investors began confusing the redistribution of risk with the disappearance of risk. The next step was financial engineering. Thousands of mortgages were pooled together and transformed into mortgage-backed securities. Instead of one investor owning one mortgage, investors could buy claims on the cash flowing from enormous pools of homeowners making monthly payments. Those pools were then divided into different layers or tranches. Some investors would absorb losses first. Others would be protected until losses became much larger. In theory, this structure allowed different investors to choose different levels of risk while making mortgage finance available on a much larger scale. The problem was not securitization itself. Securitization had existed for years and could spread risk across the financial system. The danger came from the belief that spreading risk had somehow made that risk disappear, especially when increasingly weak mortgages were being added to the machine. Credit rating agencies became essential to that transformation. Many senior portions of mortgage securities received extremely high ratings, sometimes the same top rating given to the safest corporate or government-related debt. Those ratings allowed pension funds, banks, insurance companies, and other institutions to hold securities they might otherwise have avoided. Then the structure became even more complicated. Lower-rated pieces from mortgage securities could be gathered into collateralized debt obligations, or CDOs, and divided into new layers again. Risk that had already been sliced once could be repackaged, rearranged, and sold through another structure. Mathematical models suggested that diversification could protect the highest-rated layers as long as mortgage defaults did not rise together across the country. But that assumption depended heavily on historical relationships continuing to hold and on national housing prices avoiding the kind of broad decline the market had come to consider unlikely. When home prices finally began falling across many regions at the same time, those assumptions started breaking down. Securities that had looked diversified were exposed to the same underlying force. Borrowers defaulted, mortgage cash flows weakened, and investors discovered that supposedly separate risks were far more connected than they appeared. But even that was still not enough to create a global financial collapse. Losses can hurt banks without destroying the entire system. What made the situation truly dangerous was how much borrowed money Wall Street had placed on top of those assets. The next part of the machine was leverage. Leverage is one of those financial words that sounds complicated until you strip away the jargon. Imagine you have $10 of your own money, borrow another $90, and use the full $100 to buy an asset. If that asset rises in value, your return can look spectacular. But leverage works in both directions. If that $100 asset falls by just 10%, the $10 of your own capital can disappear completely. A relatively small decline in the value of the asset can wipe out the equity supporting the entire position. That basic mechanism mattered enormously in 2008 because many major financial institutions were operating with very high levels of leverage. They held enormous portfolios of mortgage-related securities and other assets while supporting those positions with comparatively thin layers of their own capital. As long as asset prices remained stable and funding remained available, leverage magnified profits. It made Wall Street look efficient, sophisticated, and extraordinarily profitable. But once mortgage securities began losing value, the same multiplier started working in reverse. Losses that appeared manageable on paper could suddenly threaten the survival of entire institutions, and leverage was only half the problem. Many firms were financing long-term or difficult-to-sell assets with money that had to be borrowed again and again over very short periods. Some of that funding came through repurchase agreements, commercial paper, and other forms of wholesale short-term borrowing. Think of it like building a skyscraper with loans that have to be renewed every morning. The building may be valuable. The assets inside may eventually pay off. But if the lenders refuse to renew those loans tomorrow, none of that matters. The institution can run out of cash before anyone agrees on what its assets are really worth. This was the hidden vulnerability inside the system. Wall Street did not merely need its investments to perform. It needed other financial institutions to continue trusting those investments enough to keep providing funding. That meant confidence itself had become part of the machinery. Once investors began questioning mortgage values, they also began questioning the firms holding them. Once they questioned the firms, lenders demanded more collateral or refused to lend at all. And when short-term funding started disappearing, the crisis changed character completely. It was no longer just a housing problem. It was becoming a modern bank run, except there were no crowds outside branches and no depositors demanding cash from tellers. The run was happening inside the shadow banking system, through trading desks, collateral calls, and funding markets that most Americans had never heard of. By 2007, the crisis was moving into a part of finance most Americans never saw. It was called the shadow banking system, a network of investment banks, money market funds, securitization vehicles, repo markets, and other institutions that created credit outside traditional deposit banking. The name sounds secretive, but shadow banking was not necessarily illegal or hidden. The real issue was structure. Traditional banks relied heavily on deposits and had access to established protections. Shadow banking depended far more on short-term market funding that could disappear almost instantly when confidence weakened. In a traditional bank run, frightened depositors line up outside a branch and demand their money back. In a modern market run, the panic looks different. Lenders refuse to roll over financing, counterparties demand more collateral, and investors stop accepting securities they trusted only days earlier. That distinction matters because the system could appear calm on the surface while liquidity was vanishing underneath it. There did not need to be crowds in the street. A few phone calls, rejected trades, and higher collateral requirements could remove billions of dollars in funding from an institution within hours. Mortgage securities were especially vulnerable because their values were becoming harder to determine. As housing losses increased, investors no longer knew exactly how much certain securities were worth, and if they could not value the collateral, they became less willing to lend against it. That created another destructive feedback loop. Falling asset prices reduced confidence. Lower confidence reduced funding. Less funding forced firms to sell assets. Forced sales pushed prices lower. Lower prices created more losses, which damaged confidence again. A liquidity problem could quickly become a solvency problem. By the summer of 2007, parts of this machine were already breaking. Mortgage lenders were failing. Funds exposed to subprime securities were reporting losses. Credit markets were growing nervous. The crisis had begun, even though most Americans had not yet heard the names that would later define it. Then, in early 2008, one of Wall Street's most famous investment banks came dangerously close to collapse. Bear Stearns was not the final disaster, but it was the warning shot. And what happened next should have told everyone that the financial system was already in serious trouble. By early 2008, the cracks in the financial system were becoming impossible to ignore. Bear Stearns, one of Wall Street's major investment banks, had deep exposure to mortgage-related securities and depended heavily on short-term funding to keep its enormous balance sheet operating. The warning signs had started months earlier. Two Bear Stearns hedge funds tied to subprime mortgage securities collapsed in 2007, revealing how difficult those assets had become to value. But the parent company survived, and many investors still believed the broader financial system could absorb the damage. Then, confidence disappeared with astonishing speed. In March 2008, counterparties began pulling away. Lenders became reluctant to provide financing, and Bear Stearns faced a rapidly shrinking supply of cash. The institution did not need every asset on its balance sheet to become worthless. It simply needed enough lenders to stop trusting it. That is the crucial difference between losing money and losing liquidity. A firm can survive large paper losses if it has time, capital, and access to funding. But when billions of dollars must be financed continuously, a sudden loss of confidence can turn a manageable problem into an emergency within days. The Federal Reserve helped arrange emergency financing, and JP Chase agreed to acquire Bear Stearns. The immediate collapse was avoided, but the rescue sent a disturbing message. A major Wall Street institution had nearly failed because the market no longer trusted the value of the assets supporting its short-term borrowing. For a moment, the rescue appeared to calm the system. But it did not solve the underlying problem. Housing prices were still falling. Mortgage losses were still growing. Financial institutions still held securities nobody could confidently value, and nobody knew exactly which institution was carrying the most dangerous exposure. Even worse, the Bear Stearns rescue created a new uncertainty. Investors now had to guess not only which firm might fail next, but whether the government would save it. 6 months later, that uncertainty would become catastrophic when another investment bank approached the edge. Its name was Lehman Brothers. By September 2008, Lehman Brothers had become the next major test of the financial system. The firm was heavily exposed to real estate and mortgage-related assets, many of which were difficult to sell and even harder to value as housing losses continued to spread. Lehman tried to raise capital, shrink its balance sheet, and convince investors that it could survive. But confidence was deteriorating faster than management could repair it. Potential deals failed. Counterparties grew nervous, and lenders became increasingly reluctant to provide the short-term funding the firm needed every day. According to later SEC testimony, the immediate cause of Lehman's bankruptcy was a collapse in confidence about the firm's viability. Concerns over illiquid assets, questionable valuations, and mounting losses caused counterparties to demand more collateral and withdraw financing at precisely the moment Lehman needed liquidity most. The numbers show how quickly the situation deteriorated. Lehman reported a liquidity pool of roughly $41.5 billion at the beginning of the week of September 8. By the end of that same week, according to information later provided to regulators, available liquidity had fallen to about $1.4 billion. That was not simply an accounting problem. It was the financial equivalent of oxygen disappearing from the room. Lehman still owned enormous amounts of assets, but assets do not pay tomorrow morning's obligations if nobody is willing to lend against them and buyers refuse to pay anything close to their reported value. Over the weekend of September 13 and 14, government officials and Wall Street executives searched for a private solution. No workable rescue emerged. Unlike Bear Stearns 6 months earlier, Lehman did not receive the support necessary to secure an acquisition. On the 15th of September 2008, the firm filed for bankruptcy protection. The bankruptcy became the defining image of the crisis. Employees walked out carrying cardboard boxes. Markets plunged. Television screens around the world flashed the Lehman name. But treating that morning as the beginning of the disaster confuses the explosion with the machinery that made the explosion possible. Lehman did not create falling home prices, excessive leverage, fragile mortgage securities, or short-term funding dependence. It combined all of them inside an institution that could not survive once confidence disappeared. And its failure sent a terrifying message across global markets. a major Wall Street firm could actually be allowed to die. That message changed behavior almost immediately. Banks became more suspicious of counterparties. Investors rushed towards safety. Funding markets tightened. Institutions began hoarding cash because nobody knew which balance sheet might be next. The crisis had moved from declining asset values into something far more dangerous: generalized fear. And then, only one day after Lehman's bankruptcy, that fear reached a corner of finance that millions of investors treated almost like cash. A major money market fund broke the buck. At that moment, the panic escaped Wall Street and began threatening the machinery that financed everyday economic activity. The day after Lehman filed for bankruptcy, the crisis reached a place most Americans had never imagined could become unstable. The Reserve Primary Fund, a large money market fund considered extremely safe, held Lehman debt that suddenly became almost worthless after the bankruptcy. That loss pushed the fund's share price below $1, an event known as breaking the buck. Money market funds were not supposed to behave like volatile investments. For millions of investors and institutions, they functioned almost like cash, a place to store money while earning a small return. Once that confidence cracked, investors rushed for the exits. Roughly $300 billion flowed out of prime money market funds during the week beginning September 15. The panic was no longer limited to investment banks holding mortgage securities. It was spreading directly into the machinery that financed short-term business activity. That mattered because money market funds were major buyers of commercial paper, the short-term debt used by corporations, financial institutions, and other organizations to finance everyday operations. Companies depended on those markets for working capital, payroll, inventories, and obligations that could not simply wait for Wall Street to calm down. Now the crisis had crossed a critical boundary. A falling house price in Nevada could damage a mortgage security in New York. That loss could weaken an investment bank. The bank's failure could trigger withdrawals from money market funds, which could then remove funding from companies that had nothing to do with subprime mortgages. This was contagion in its most dangerous form. Problems were no longer staying inside the institutions that created them. They were moving through connections between balance sheets, funding markets, collateral, and confidence. Every institution began worrying that the next institution might be holding losses nobody could accurately measure. At the same time, AIG was facing enormous collateral demands connected to financial guarantees it had written on mortgage-related securities. Its problems threatened another network of counterparties across the global financial system, forcing policymakers to confront how interconnected the entire machine had become. By this point, officials were no longer deciding whether one reckless company deserved to survive. They were deciding whether allowing another major institution to fail could trigger a chain reaction they could not stop. And that created the most politically explosive choice of the entire crisis: bailout or systemic collapse. By late September 2008, policymakers were facing a choice with no clean outcome. They could stand back and let failing institutions collapse, hoping the market would punish bad decisions and eventually stabilize itself. Or they could intervene on a scale that would look, to millions of Americans, like rescuing Wall Street from the consequences of its own behavior. Doing nothing carried enormous risk. Lehman had already shown how quickly the failure of one major institution could spread through money market funds, commercial paper, repo markets, and other short-term funding channels. Another uncontrolled failure could push even more lenders and investors to withdraw at the same time. But rescuing individual firms created a different problem. If investors believed the government would always step in when losses became large enough, financial institutions could take bigger risks in the future. Economists call this moral hazard, but politically the idea was even simpler. Profits had been private, and now taxpayers might be asked to absorb the losses. There was also a third option. Instead of saving one company at a time, the government could try to stabilize the entire financial system. That meant emergency lending from the Federal Reserve, guarantees for critical markets, capital injections into banks, and eventually the Troubled Asset Relief Program, better known as TARP. None of these choices was politically attractive. Allowing collapse risked a deeper depression. Selective rescues looked arbitrary and unfair. System-wide intervention required enormous government commitments and raised fears that Washington was protecting powerful financial institutions while ordinary families were losing homes, jobs, and retirement savings. This is why the bailout debate cannot be reduced to a simple argument about whether Wall Street deserved help. The real question facing officials was whether the financial system had become so interconnected that refusing to support key institutions could destroy credit flows needed by businesses and households far beyond Wall Street. Policymakers ultimately chose intervention. The Federal Reserve expanded emergency facilities. Congress approved TARP after initially rejecting it. The government injected capital into major banks, guaranteed parts of the financial system, and created extraordinary programs designed to restore confidence and prevent funding markets from collapsing further. Those actions helped stabilize the financial system, but they also created one of the most enduring political consequences of 2008. Millions of Americans watched financial institutions receive emergency support while unemployment rose, foreclosures increased, and household wealth disappeared. The crisis became not only an economic disaster, but a crisis of legitimacy. And once the immediate panic began to recede, an even harder question remained. Who was actually responsible for creating a system fragile enough to require such extraordinary intervention? On that question, even the official investigators of the crisis could not fully agree. Once the panic subsided, investigators faced a problem almost as difficult as the crisis itself. There was no single smoking gun. The financial system had failed through a chain of weaknesses, and economists, regulators, bankers, and policymakers disagreed sharply over which link mattered most. The Financial Crisis Inquiry Commission concluded that the disaster was avoidable and emphasized failures in regulation, corporate governance, risk management, excessive borrowing, and accountability. In that view, the crisis was not an unavoidable accident. It was the result of decisions made across both the public and private sectors. But several commissioners dissented. They argued that the explanation needed to place greater weight on the global credit boom, the housing bubble, non-traditional mortgages, securitization, ratings failures, leverage, liquidity risk, and the panic that followed once investors lost confidence in major institutions. That disagreement is important because it exposes the weakness of one-cause explanations. Blaming only greedy banks misses monetary conditions and global capital flows. Blaming only the Federal Reserve ignores underwriting failures and leverage. Blaming only borrowers ignores the institutions that designed, financed, rated, and distributed the loans. The role of interest rates remains especially controversial. Some economists argue that the Federal Reserve kept rates too low for too long, encouraging borrowing and pushing investors toward riskier assets. Others argue that global savings, financial innovation, regulatory failures, and private sector incentives played equally important or larger roles. Government housing policy has also become part of the political argument. Some critics blame federal efforts to expand home ownership. Others point out that many of the riskiest mortgages were originated outside the programs most commonly blamed, and that the Community Reinvestment Act was not considered a major cause by several official investigators. Even the importance of Lehman itself remains debated. Its bankruptcy clearly intensified panic and damaged confidence, but the system was already under severe pressure before September 15. Bear Stearns had nearly failed. Mortgage markets were deteriorating. Short-term funding was becoming unstable. The crisis did not begin with Lehman. So what did economists get wrong? Not that any one factor was imaginary. Most of the major explanations contain part of the truth. The deeper mistake is treating those factors as competitors, as though one must be selected while the others are discarded. The crisis was a system failure. Cheap credit expanded the fuel supply. Housing optimism increased risk-taking. Securitization spread exposure. Ratings disguised uncertainty. Leverage magnified losses. Short-term funding created fragility. Falling home prices triggered stress. Panic connected all of them. And once those forces began reinforcing one another, the question was no longer who had made the first mistake. The real question was why the financial system had been built so that a decline in one asset class could threaten credit, employment, savings, and economic activity across the world. The real lesson of 2008 is not that one group of bankers became too greedy, one regulator fell asleep, or one investment bank made the wrong bet. Those things mattered, but none of them, by itself, explains how losses in American housing became a global economic catastrophe. Cheap and abundant credit helped inflate housing. Rising prices encouraged weaker lending. Mortgage demand fed securitization. Credit ratings made complicated securities appear safer. Leverage magnified exposure. Short-term funding made institutions dependent on constant confidence. Then housing prices fell, and every weakness began interacting with the others. That is what made the system so dangerous. Risk had not disappeared when mortgages were packaged and sold. It had been redistributed, multiplied, and connected to institutions across the financial system. Once losses appeared, nobody knew exactly where the largest exposures were hiding or how severe they might become. Lehman was not the beginning of the crisis. It was the moment the crisis became impossible to ignore. Its bankruptcy turned uncertainty into panic, panic into funding withdrawals, and funding withdrawals into a broader freeze that threatened companies and households far beyond the mortgage market. The first lesson is simple. Moving risk does not eliminate it. The second is even more important. Liquidity can disappear faster than anyone can determine whether an institution is truly insolvent. When a financial system depends on confidence, fear itself can become a powerful economic force. The third lesson is about leverage. Borrowing can magnify profits during good times, but it also magnifies mistakes when asset prices fall. A small decline becomes dangerous when institutions have only thin cushions of their own capital standing between manageable losses and complete failure. And the fourth lesson reaches beyond finance. Complex systems rarely collapse because of one mistake. They collapse when multiple weaknesses become connected, when one failure increases pressure on another, and when institutions lose the capacity to absorb shocks that once would have remained contained. That is why the most visible explosion is rarely the true origin. When the next crisis arrives, the most useful question may not be, what broke first? It may be, what made the system too fragile to survive the break? The cardboard boxes carried out of Lehman headquarters became the symbol of 2008. But they showed us where the crisis finally broke through the surface, not where it began. The real origin was built years earlier. One incentive, one assumption, and one layer of hidden fragility at a time.